So I have a 20-year interest in how people grow businesses in places that seem risky, seem dangerous, seem out of the ordinary. When I was a student back in my MBA, I had this wonderful opportunity. The Darden School had a project which involved inviting students to take proposals to go study businesses in the Soviet Union. I had just heard about the newly opened Pizza Hut operation in Moscow, and through a series of relationships was able to find agreement to the writing of a case study about that organization, an agreement with some of the faculty at Darden, but also some of the folks at PepsiCo, Pizza Hut, that actually agreed to the writing of this case about how, in fact, the Pizza Hut company came into what was still a socialist communist country to offer a new type of business, not only the type of business that would be a relative fast food sit-down restaurant, but would also be a new type of food, pizza, which was not really consumed in the country at that time, with a strong, by the way, Italian/American recognition at a time when the Cold War was at its waning, but still existed. And I was very interested in the question of how one does that, and I found in so many ways in the eventual work that we did that the managers in that organization were operating without many of the tools or many of the data sources that you typically find here in the States. It was hard to determine what the size of the market would be. It was hard to determine who they'd hire. There wasn't examples of this same type of format that existed or people that had lots of experience in the same type of format. And the case really described in all the ways this organization had to really think about what were all the pieces of a delivery system that needed to be recreated. And I just became very interested in that set of questions. Over the intervening years, both in my doctorate and in my early years as a faculty member, I've continued to be interested in going to study businesses that are starting in those places that most people don't. There was a period that I got then an intersection with the finance world. There was a period in my doctorate where I began focusing on financial institutions that operate in those areas. And so a series of projects that I worked on at that time involved Citigroup and Citigroup's opening of new banks in Eastern Europe, in Latin America. This was a period of big growth of that type of thing. And then even very interestingly, some of Citigroup's operations in Los Angeles, California, and Vegas around some of the new immigrant populations that were coming in at that time. And so this set of questions then began to shift from an organization like a Pizza Hut to organizations like banking institutions. My interest has always been then in that intersection, the financial institution and the entrepreneur that's operating in the place that isn't Route 128, that isn't Silicon Valley, and how the individuals that have ideas then find their way to get the assembled resources, often capital, but even people, even technology, even supplies that help the business run. I think that there's often a discussion that people have about why some places grow and why some places don't, even within a very prosperous nation or a very prosperous region. And there are lots of questions people have about why those things happen or don't happen. Those were the questions that really encouraged and interested me. And so in that regard, I've always been trying to answer and being in that rub place where the frictions could be high. And so my work has dealt with, in one period, private equity firms who are promising very high returns, but private equity firms that are thinking about low-income areas, thinking about new technologies that haven't really shown the type of market pull just yet, private equity firms that are thinking about women-owned, minority-owned businesses. And a series of my research, both published and the things that I've done in the case world, have been about that question. I found, by the way, that it is in fact the on-the-ground field work and the statistical work and the way they speak to each other which leads to, in my mind, uncommon findings. That work that I was doing on private equity firms engaged me in a discussion with a number of national organizations interested in that set of questions, including the MacArthur Foundation. And they were wonderful enough to provide me funding and support for a multi-year project looking at the field of community development finance. This is a field that includes 800 what are called CDFIs, Community Development Financial Institutions, from around the country. But I think they're organizations that people largely don't know about, especially in business. These are organizations who provide lending capital to both individuals, to facilities, Charter schools are a big movement in the U.S. right now. Nonprofits that are growing sometimes might want to own a building. There are only certain types of banking institutions that are willing to take the risk of offering capital to a charter school or offering capital to a local nonprofit. CDFIs do that. CDFIs are also organizations that do work providing banking services to the people we call the unbanked. I think people are only roughly aware of what portion of the U.S. population actually lives in a state that we call asset poverty. Asset poverty being not the federally prescribed poverty rate, which is $25,000, $26,000 for a family of 4. Asset poverty encompasses a much larger group and in fact is a bit more of a worrisome problem. Asset poverty is defined by those individuals in the population who, if they lost their job, would not have 3 months of assets or savings to float themselves. And these numbers have long been above 25–30% in the U.S. Very few people have assets to float themselves for that period of time. So the work of CDFIs often focuses on asset building, that is savings accounts, checking accounts, but also thinking of financial products that are appropriate for that community. Because this is a community that wouldn't have a 401k. Wouldn't have certain types of opportunities to build asset values, but there are specific products for those organizations, and I've been studying the strategies used by those organizations and also the financial viability of those organizations. And so this is a project where, again, qualitative and quantitative pieces are speaking to each other. That's work that is now spooling over into other arenas. A new project that I've begun involves the question of providing financial services to our rapidly growing Latino population in the U.S. And also other immigrant populations. The challenges for those populations might be ones that involve the very obvious things of lower income and might be very obvious things of questions of language. But in fact, there might be others that are really, really critical. So with our rapidly growing Latino population, one of the realities that you have is that people are living in communities, working in communities, have their children in our schools, and yet they aren't having access to the financial services sector. So that people have a challenge in building credit. People have a challenge in buying and acquiring the things that they like. People have a challenge in creating an asset-based safety net. And in each of these instances, the organizations that operate in those areas have really started thinking critically about how one does that. How, in fact, do you underwrite credit for someone who actually has no legal identity in the U.S.? And in fact, there are organizations doing that. How do you help put them into the financial system so that later on they could be bona fide members to, for instance, purchase a home? These are really important questions and really interesting questions. By comparison, the Chinese immigrant population, let's say in the New York City area. This is a population that might not have some of the same features in terms of people being documented and undocumented that you might find in the Latino population, but has a different set of challenges. Those challenges are that even though there's a similar written language, that in fact there are many dialects spoken in China, and on arrival in the States, to run a Chinese immigrant-focused bank requires not just one official language, but perhaps many different languages. Secondly, what bankers in this arena find is that there are certain things that people really want. Passbooks, which many of the older people listening to this might remember, are very critical to banking this population because people really want to see and physically note what's happening. And online banking, telephone banking are less viable. Finally, the hours. Our banks typically, the old joke is banker's hours, 8 in the morning till 3 o'clock in the afternoon. Many of the people working in the New York area work in service businesses where they are actually at work between 8 and 3. And so the people that bank to this population have recognized that Saturday hours, Sunday hours become critical places and times when people can get in and get their banking done. And again, they need to do it face-to-face and they need a passbook to do the work that they do. Another area in this arena of community development finance are in fact the private equity firms. And there are these organizations called community development venture capital firms. They've existed since the social programs of the 1970s. They recognize that in addition to loan capital, there might be equity capital and smart equity capital that's needed in growing areas. And so these organizations, some in Appalachia, some in rural California, some coming out of Native American dollars generated out of casinos, find ways to, in fact, spur business growth. Again, the smart money that now is applied to these challenges in these areas. And through a combination of both their own dollars, matched dollars from the SBA, matched dollars from the New Markets Venture Capital Program, another federal program, these organizations are thinking hard about the strategy that's involved in growing those areas. Now, one of the problems with any type of social business research is what I call the "it's all good" problem. And I want to be clear. This research is critical. And by critical, I mean there are models that organizations are employing that aren't working. And there are models that organizations are employing that I'm critical about. Sometimes with social change work, it's just neat to hear that there's an organization that cares about, that is engaged in, and is even putting any money into low-income areas. I think that, unfortunately, and that mindset that the story ends with just the knowledge that there is the organization doesn't do these organizations or these industries the service they need. With a lot of research that involves social change organizations, the story ends when you hear that the organization exists, and that's the extent of what people want to focus on. What I've recognized is that that's necessary, but it's far insufficient. And it, in a sense, really doesn't credit the managers that are doing good work in this industry, nor does it really allow for the opportunity for there to be the type of criticism that would really drive these organizations to be better. If we don't take time to critically evaluate these organizations and give the tough news that has to be given, what we're actually doing on some level is we're failing to recognize either the talent and the strategies that these organizations have that other businesses could learn from, but we also fail to take the view that these are really serious business organizations that we need to think about in serious ways. In effect, we've decided to, in some cases, relegate simply the story to the feature component of what if we thought about a newspaper, we've decided to relegate some of these organizations to the feature column. We don't really talk about them in the business column, which would mean we ask tough questions. And the research that I've been involved in largely asks, how are they doing it? Why are they doing it? But how successfully they're doing it using quantitative metrics like return on equity, return on assets, ratios that are important in these types of industries, liquidity ratios, various types of risks these organizations put themselves through.